Welcome to The Explainer. Today, we're unpacking one of the most confusing yet absolutely fascinating financial stories in global tech right now, the incredible paradox of Samsung Electronics. I mean, on paper, this should be a massive victory lap for the company. But as we're going to see when we look closely at the data, the reality is a whole lot more complicated.
Okay, let's start by wrapping our heads around this staggering figure. In the second quarter of 2026, Samsung posted its highest quarterly revenue in history, hitting an unbelievable 171.5 trillion won. And it doesn't stop there either. Alongside that revenue, they posted an all-time record operating profit of 89.5 trillion won. You guys, these aren't just good numbers. These are monumental, record-breaking milestones for the tech giant.
But here is the paradox we really need to unravel today. Despite these massive historic financial wins, Samsung's stock plummeted more than 10% in a single week right after the announcement. The market literally didn't cheer at all, it aggressively sold off. So what is actually going on here? Is the company a screaming buy at these levels, or is the market trying to tell us that we've hit a peak? To figure out why the market is selling instead of cheering, we're going to unpack four key things today: the AI money printer, the internal squeeze, the shareholder shield, and our final verdict. Let's dive into part one, the AI money printer, and Samsung's semiconductor dominance.
This right here brilliantly illustrates exactly where the money is coming from. Out of that massive 89.5 trillion won in total operating profit we just talked about, a staggering 89.2 trillion won came from the Device Solutions division alone, which is essentially their chip business. The rest of the company barely even registered in comparison. And this dominance is being driven entirely by an insatiable demand for high bandwidth memory, or HBM, which is absolutely crucial for powering modern AI data centers.
And that dominance? It's the result of an incredible technological sprint. AI data centers are just starving for these memory chips to sit next to their powerful GPUs. In February 2026, Samsung became the first in the world to mass-produce 6th-generation HBM4 chips. By May, they were already shipping samples of the 7th-generation HBM4E, and by September, they're breaking ground on a brand-new 6 trillion won HBM fabrication plant. This hyperdemand is so intense, it pushed memory chip prices up over 80% quarter over quarter. So, management is going all in. Chairman J.Y. Lee personally inspected the Cheonan HBM plant in June, and they're rapidly expanding the Pyeongtaek facility too. But here's the crucial point. While the company is aggressively expanding capacity to meet the structural AI demand, the stock market might have already priced all this good news in. Remember, Samsung's stock already rallied over 150% in the past year and a half. Expectation has officially met reality, and well, that often triggers profit-taking. Now, let's move to part two, the internal squeeze, also known as the consumer crunch.
Because if we flip the coin, the very chips padding Samsung's bottom line are causing a massive crisis elsewhere in the company. On the surface, the mobile experience division, the folks making your Galaxy smartphones and tablets, appears to be crushing it. Sales of the new Galaxy Z Fold 8 and Flip 8 were excellent. In fact, in South Korea alone, they smashed domestic records with 1.44 million units pre-ordered. That actually beat the long-standing Galaxy Note 10 record from way back in 2019. So the phones are definitely selling.
Yet, shockingly, for the first time since the division was launched, it posted an operating loss of approximately 800 billion won in Q2 2026. Let that sink in for a second. How do you sell a record number of phones and still manage to lose almost 1 trillion won? The culprit? It's an internal transfer pricing problem. Remember that incredible 80% price surge in memory chips that made the semiconductor division so rich? Well, those same exact chips have to go inside Samsung's phones. Samsung is basically paying itself 80% more for memory components. It turns a massive corporate win into a severe margin killer for the smartphone division, and the market simply does not like that kind of internal friction. Which naturally brings us to a vital question. Can Samsung just raise their smartphone prices enough to offset these skyrocketing component costs? Facing fierce competition from Apple on the high end and Chinese brands across the board, pricing power really isn't guaranteed. And this lack of pricing power exposes a dangerous structural issue. Samsung's profits are becoming incredibly concentrated in semiconductors. If AI demand slows down even a little bit, the entire company's bottom line is suddenly highly volatile. All right, so that's the bad news. Let's look at part three, the shareholder shield, and whether it creates a floor for the stock.
To protect investors, Samsung is deploying something massive. According to verified reports, they are expected to approve an absolutely giant shareholder return policy worth more than 100 trillion won. That is roughly 72 billion US dollars. This plan is set to be approved at their end of August board meeting, and it basically acts as a huge safety net for value investors looking for yield. This marks a fundamental shift away from their historical tendency of just hoarding cash. They're now committing 50% of their free cash flow to this program, and special dividends are expected on top of the regular payouts. Because of this, major banks like Goldman Sachs and Citi have found a solid reason to maintain their buy ratings on the stock. They view this massive cash return as a backstop against any further stock drops. But we always have to ask, is this buyback bump already priced in? Some analysts argue that the recent stock pullback happened precisely because the market already anticipated this move. A 100 trillion won return plan is fantastic, for sure, but ultimately it's just a commitment to distribute existing cash, not a signal of new underlying growth. It's a positive catalyst, absolutely, but not necessarily a game changer for the company's valuation. Finally, Part 4, the final verdict, and the main takeaway for investors. Let's break this down by your specific timeline. For long-term investors with a 5 to 10-year horizon, Samsung offers vital, foundational exposure to the biggest tech trend of our lifetime. The valuation isn't extreme relative to its earnings power, and AI demand definitely appears structural. On the flip side, short-term traders should probably brace for massive price swings. The consumer electronics division is bleeding, component costs are going to stay high in the second half of 2026, and the stock is going to be highly volatile around any HBM news or shifts in massive capital expenditures. Ultimately, the most important signal you need to watch going forward isn't actually Samsung itself. It's the massive capital expenditures from the hyperscalers, the Microsofts, the Amazons, and the Metas of the world. Because if they stop aggressively spending on data centers, this entire semiconductor cycle could turn, and Samsung's profits could just evaporate. So I leave you with this to ponder. As you watch the tech landscape shift over the coming months, is the AI music still playing? Thanks for joining me on this explainer, and I'll see you in the next one.